Now I would like to discuss with you a really very interesting phenomenon, so-called zero debt capital structure. And again, there is a question whether we really see the magic in financial leverage. So that part of our discussion is saying no. There are some types of companies which do not feel any magic in financial leverage at all. So what is this zero-level debt puzzle? At first, few illustrations again from empirical research papers. You may see that even in the United States, a very well-developed economy, there are many companies which are non-financial companies in non-financial sector, which will have zero debt in their capital structure. Even they will not have short-term interest-bearing debt outstanding. So they live in their business and they go through their life cycle stages without any debt. Almost 32% of the companies within this period of observation also didn't have zero long-term debt outstanding. And only 22% of companies, they have just some financial leverage, which is really low, only 5% debt ratio, the debt to average assets ratio. So what are the reasons why they do not use debt in their financing within this really long-term period of time? What could be the reasons? At first, let's say a few words about particular interesting characteristics of this type of companies with zero debt capital structure. And researchers, they used to match two samples compared by the operational profiles companies, but very different in terms of their financing policies. Zero-level debt companies and their peers matched to them by operational profile, but with the financial leverage. Those who have zero level of debt, surprisingly, they have higher market-to-book ratios, and they have higher profitability measured with the help of their financial statements. Almost 1/3 of those companies with no debt in capital structure, they pay dividends on a regular basis. And as compared to some other companies with financial leverage, they pay even higher amounts of cash in dividends. Those companies are not really very young. In most cases, they are closer to the maturity stage in their life cycle. If we try to explain the non-existence of the debt in their capital structure looking at their balance sheet, if we try to explain it by lease agreement or so-called pension plans, which pension plans, so this is like a deferred debt of the company in front of their personnel, deferred money, they will pay them out. That's like an obligation of the company, but still it cannot be explained by existence of this particular relationship. In many situations, those companies which do not have debt in their capital structure, we can observe that the chief executive officer, the top guys, they will have ownership in that particular business, and even the ownership proportion would be higher as compared to their peer companies with financial leverage. In many situations, this would be so-called family companies. And within this period of observation, you see that even within 5-year periods, almost 1/3 of companies didn't raise any debt, but they continued investing, and therefore they funded their investment project by equity. Let's try to understand now what does it mean. This situation when some companies continue maintaining zero leverage capital structure. What could be their motives behind that very original decision? We can explain it at least by the trade-off theory of capital structure we studied in a previous class. Can we explain it by some financial constraints or by some conservative policy of these companies? Maybe this decision is due to some particular very specific investing policies of these companies, or maybe macroeconomic trends were really very influential. And that's why maybe this windows of opportunity approach, if applied, can explain that they didn't want to time the market when debt prices were increasing, or maybe some other reasons behind. So let's go into some details. To some extent, yes, maybe we can explain this type of very original behavior by the trade-off conception. And then it will mean that at least in some years, the marginal benefits of debt financing got just equal to the marginal costs of financial distress. And that's why they were not looking for additional debt. And they didn't increase their financial leverage, and they didn't want additional debt. Or maybe we can just explain it by very high cost of adjustment to the target capital structure. But this is only for few companies that can be explained by this framework of trade-off conception. When we are looking forward to the financial constraints or the conservatism in their financing policy, we may find different papers which can really confirm that could be the reason. For family companies, because they don't want their income to have this burden in the near future, and they really want to secure that income for their successors in the nearest future without any burden. But this is the specific psychology of this family-managed and family-owned firms. In some cases, this could be companies with the lack of reputation in the debt market. They really don't have credit history, and they still didn't want to enter into this financing choice and to have some debt in capital structure. In some situations prior to the International Financial Reporting Standards changes, when lease agreements were off-balance sheet financing, they were treated as off-balance sheet, not among the liabilities. They could explain to some extent the non-existence of interest-bearing debt in the balance sheet of the company, but they used heavily the leasing agreement. But after the changes in the International Financial Reporting Standards, when a leasing agreement, even not only finance lease but also operating lease, should be disclosed in the balance sheet, it's no more an explanation. So how about the investment decisions? Maybe they are looking for this zero leverage, accumulating their good reputation among the investors, and accumulating money, not paying them out for potential debt before high, very huge, or really abnormal investments. This type of hypothesis was also explored in some papers, and in some of those papers it was confirmed. And of course, macroeconomic trends also can matter, especially in terms of the window of opportunity suggestions. So these are the periods when there were some overvalued stocks and undervalued stocks, and the companies would like to benefit from the periods of these changes in under and overvaluation of other stocks.